Investing in rental property. It's a question we get asked a lot here at the firm. Should people be buying rental properties? Some of it depends. It's a big financial decision, right? Not only a time commitment, but from a financial standpoint, you want to make sure that the numbers make sense. So today's video aims at helping you decide and navigate some of the questions that you're going to have to ask yourself and some of the mathematics behind rental properties and whether it makes sense to buy a rental. Usually, rental properties can be a great diversifier, right? They represent a physical presence in the portfolio. They can bring in passive income. They're also really tax efficient due to the depreciation you're able to take on the property. So some of the decisions you're going to need to make, one, revolve around why are you buying the property in the first place? Or why do you want to buy the property? Is it so you can have passive income? Is it to gift to the kids at some point? Is it because you think the property is worth less than the market's value and you're trying to get the market appreciation on it? There's a lot of decisions that go into it, and usually you can't have both. Usually a property that generates good cash flow isn't necessarily going to grow with the market. So different regions will provide different rates of return on rental properties. So first question, again, why are you buying the property? Income, capital appreciation, is it a gifting mechanism, estate planning? That's your first step. And then the second goal is the old age additive of real estate, right? Location, location, location. Where are you buying this place? If it's in Southern California, is it in Michigan? Is it in Alabama, Florida? There's all different geopolitical areas to be buying real estate. They all have different tax ramifications. There's different areas of the market, cash flow wise, might be better or worse. So the location is going to be key. Third will be the financial decisions, and we'll walk through an example here in just a minute on the actual mathematics and calculating whether a rental property pencils out. Does it make sense to buy a property? So let's run the numbers. Let's say you want to buy a place and it's $500,000, right? So $500,000 is your purchase price, and you're going to put 20% down on the property. So $100,000 is your initial investment, and you are going to finance the remaining $400,000, okay? This is the starting point, okay? Typically, rental real estate, you're not gonna get as advantageous rates on the property just because it's not a primary residence. So that's something to consider. For our example, we'll use 3.25%, okay? Over a 30-year period. That's probably gonna give you in the range of about $1,750 a month, just principal and interest. So now that we know our principal and interest payment is going to be roughly $1,750 a month, you need to add the other expenses associated with the property. So property taxes, right? That's a component of the property. Let's just use $450 a month. Depending on the geographic location of the property, it could be higher, it could be less, it just depends. You'll need to insure it, right? So you need to pay some insurance. Let's just assume about $100 a month there. And then, depending on your school of thought, you might want to have a reserve for maintenance, some fixtures, things break. So let's just assume $200 a month, right? Generally, you probably want to keep anywhere from 10 to 15% of your gross rents as kind of a maintenance reserve. So you're all in about $2,500 a month just in fixed expenses. That doesn't take into consideration whether or not you're going to get a property manager, if it's out of your location, if you want to self-manage it, right? Those might be some additional costs to consider. So $2,500 a month, that's your all in. And let's just say for example purposes, you can get $2,700 a month gross rents. Well, $2,700 minus $2,500 is $200 a month, right? This is like your net cash flow, take home kind of profit from the property. But what does this even mean? $200, that's $2,400 a year, okay? Let's go to another slide here. So $2,400 is the net cash flow from that property. Well, is that good or not? Well, let's start again with the original purchase price of $500,000. You put $100,000 of your own money in. This is your initial investment. Right, so $100,000, it generated $2,400 of cash flow. That's a 2.4% rate of return. And so the question then becomes, is that a good rate of return or not? It's going to depend on the location of the property. So I'd say if that property that we just discussed was in Southern California, that's right around market average of what you're going to expect. But that $500,000 property might grow exponentially quicker, so your rate of return overall might be a little bit higher. Whereas if that $500,000 property is in, say, Michigan or Alabama, you might get more property for $500,000, which would lead to higher commensurate rents. And if the rents are higher, given the same example we just went through, your cash on cash rate of return might actually be higher. But that $500,000 property might not grow as much. So it's a little bit of what you want out of the rental property. Again, do you want it for income, or are you trying to pick up capital appreciation on the back end? So I hope this video has helped you figure out whether or not a rental property is right for you.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.